Happy New Year and Happy New Ideas. So today I'm going to discuss some interesting thing, the algorithmic trading versus discretionary trading in a specific kind, the one that I personally do. So let's see who wins in this case. But before I begin, little disclaimer, again, this is just me trading. I'm doing this type of trading. So whatever I do your own due diligence. Don't just repeat blindly what I do. Okay? This is what I do and how I do it. Now, so who is the ultimate winner? Is it the algorithmic trading or discretionary trading, which is still rule-based trading, but still different kind, where I can use my discretion to decide when to get in, when to get out, and what to do. So let me just tell you what the idea is about. It's all about. So the idea was, okay, which one is better, rule-based trading or experienced or intuition-based trading? Because it's, even though, as I said, it's still rule-based, but you can use a lot of your discretion to make these decisions. So let me start from the experience-based trading. So I trade this specific system. It allows me to use almost like a mini version style setup, but for a specific type of setup. So I'm not going to go through all the rules, but let me just show you what I mean. So as an example, what I noticed that Algo was one of the popular stocks back in 2024, when all of a sudden it started to go on a parabolic move. So when that happens, you know that there is an inevitable fall coming. So this fall, which was signified by this huge red bar, it's like, oh, the fall is coming. So due to that, I will be looking for a continuation of the fall, and then once it stabilizes and start to go up again, this one I will make my move. Okay, so here's what I'm doing here. Like it fell, and now I'm ready to get in right there. Okay, let me show you what I mean. Okay, so I put an entry price right here, where it breaks from the lows. I put my risk as the lowest low in that case, and then I put the profit target as the highest high that we had before. Okay, that's one of the ways to trade it, that particular setup. As I said, I will probably have some specific workshop about this type of the system, but that I do still trade periodically on discretion with my smaller account. But anyway, so this is where you can see that it worked out just well, right? It never broke that lowest low, and it went up and it hit the profit target. Okay, great. Then what do I do next? I'm waiting for the next fall. Okay, and it fell, sure enough. Luckily, I was already out from that particular trade, which is great. Now it fell, and now I'm waiting. Okay, so let me just try to get back in over here again. Okay, so I'm trying to get back in right there. It could have been probably earlier, like here, but because the price action is so choppy, I would probably myself and discretion will say, you know what, this is my red line, is the 200-day moving average. When we break above the 200, that's when I will get in. Okay, but my risk is this particular section, right? I will use my position sizing with a risk for this, and as I said, it's not just a random number of shares. There's a specific system that I'm still using. It's just a discretion of when to get in, where to put the stop loss, and where to put the profit target. So I said, okay, let's put the profit target right there, back to the original profit target, because if I put it to this resistance line, it's just the risk to reward ratio is very small. So I would skip that type. Said, okay, let's just shoot for kind of a 2-to-1 ratio, right? The 2 win, 1 to ratio to lose. And what will happen? Well, sure enough, in this particular case, that was a losing trade. Okay, so it went up and then went down. Okay, so I lost. So one trade won, one trade lost. Not a big deal, because I'm looking for the next setup. So here's my next setup. Okay, but in this case, again, I'm using my experience in discretion. A lot of times I saw that when the stock falls below the 200 moving average like that, it can return right back to it, right back to 200-day moving average. So that's why I'll put my profit target right here, right before the 200 moving average is in. And then this price action on the left gives me a lot of confidence that, oh, it could be enough to be a resistance in this case. So let me put the profit target over there. I will, as soon as we basically found the low and then we'll go right above it, that's when we'll get in. Okay, so I'll use that at discretion. to get in. And in this case, again, it's a nice win, right? It's passed right through it, so which means that I would have triggered this profit target. Yay to me. Okay, great. So I made my money on this particular case. Now, so what are we doing now? We're waiting for the next setup. So as you can see, by the way, as I said, a lot of times the stock just bounces from the 200-day moving average. So it went down. But in this case, I don't use the short side at all. It's just a long play, because on the short side, the risk to reward ratio could be good, but could be choppy. So I personally trade it only on the long side for this particular system. Okay, just to give you an idea. So again, same setup. Right? See, I'm waiting for my stop loss. This is my profit target, not the profit target, my entry price, and here's my profit target back to the same 200-day moving average kind of action. What happened here? Well, that's a nice win. Again, I'm risking only this much in terms of the movement, but about 2-to-1 ratio of win, as you can see. So what's going to happen next? Well, actually, in this case, I said barely missed the PT because I put that price, but if you zoom in a little bit, it actually missed. I mean, it barely touched it. So most likely, it didn't trigger my full profit target. So maybe I got out just partially positioned, not full position. But what can happen in this case is sometimes it's kind of like upsetting part, right? So where it went down, but then went up again. And as you know that, it reached the same type of price action. This is again where you can use the discretion and say, I will get out on that second spike, because there's a huge likelihood that it will continue to fall down. So, and you can see if I didn't get out on the second spike, that would have hit my stop loss. Otherwise, I would have gotten out as a smaller profit, but that's my discretion comes into play. Okay. Now, here's the third setup in this case. Try again, right? Again, that's the same resistance zone. And you can see that the 200 is kind of like falling a little bit. So I'm kind of bibbling underneath it, but I'm reaching this resistance line. So this is the resistance zone to the downside. You can see it's bouncing from it, and this is my resistance on the top. So it's actually it's a support over here. Sorry, to be more precise, on the bottom. It's called support, right? And this is my resistance on top. So what will happen if I'll do this approach? Well, in this case, again, it really didn't reach the profit target. It fell back. Okay. So you can see that this is the 50-day moving average, by the way, the blue line. It sometimes can bounce from the 50-day moving average. So in this case, the risk to reward ratio, it's kind of maybe enough to say in the discretion, you know what, I'll get out. But again, every time you use discretion, you kind of fiddling with your system. You really don't know what's going to happen. You sometimes can overshoot, can undershoot. You changing the ratios. So discretion, that's why it's called discretion. So there is a lot of opinion, and sometimes you can be wrong and sometimes you can be right. So in this case, it would have been nice to get out on the 50 over here, moving average, not waiting to get back to get to this area. But if you didn't, then it would have been stopped out. You can see that it exceeded, this particular bar exceeded the stop loss area. And then if you look even closer, if I didn't get out, I would have continued to fall down. But again, my approach continues, right? I can say, okay, when I'm waiting for the resumption of the move to go up, this is where I will get in. My profit target could be here, because this is clearly now a resistance zone, right? It used to be support before, now it's a resistance zone. But I can also say, well, you know what? I will use my 200 moving average as my profit target. So which one to use? That's why, again, discretion comes into play a lot. So you can say, okay, let's get out partially on this line, and then the rest of it will get out over here. So it's kind of like some people do the break even, meaning that they move the stop loss to here when they get out partially. Or they literally move if let's say we move above this line, then they will not even get out. They will move just the stop loss to it, or halfway. There's a lot of discretion involved. Okay, I didn't do that. Let's say that would have been nice because you hit either that one or you hit this one. So you hit both profit targets. Okay, so either way, it would have been a nice win. Now we use the same approach over here, right? So we pull back, And now we're waiting for the resumption to go up. Again, profit target either this resistance line or this highest high that we've hit before. Which one it is? Well, it's up to you again. You can choose the different methods to use it. And in this case, we were lucky enough. It hit both. It hit that one and it hit that one. It continued to actually go forward. But again, this is the mean reversion type of system where it has the profit target, so it cut out. So meaning that I'm not sitting and trailing. Because then if I do trail, then it's a completely different system. In other words, you can see with the discretion, we can have all kinds of setups in here. We were just fiddling over here, by the way, before. Okay, so now this is the September, October 2024 still. You can see that this is a lot of movement happening over here, a lot of false breakout. Sometimes you can see over here, I would have said, okay, we get out, we get back in and have the highest high as my profit target, which means that we probably would have touched it, but over here we would have not touched it. So that's why I'm saying that there's a lot of similar setups where you can get in, get out. It's a pretty interesting system, to be honest. I trade it manually, and it still has its own pros and cons. And again, I will have a separate probably workshop just to talk about it if somebody's interested. Even though I will tell you what I prefer shortly. Anyway, so here's the continuation up to now. You can see that this is where we were fiddling before. This thing continues to go up and up and up, right, until it hit the 170 something, maybe $60, and then it kind of rolling down now all the way from October till now. So this is where we have a lot more losing trades than the winning trades with the same exact setup. Like here, I would have never made it all the way back right here, right? So if you get in, it's a loss. You get in again, right here, it's a loss. You get in again, it's a loss. You get in again, maybe it's a win, but it depending on where you put the profit target. Like if you use that area as the profit target, that would have been a win. But otherwise, it's a loss, right? Again, this one is a loss, and so on and so forth. So you can see it's more losses than wins when it starts to drift down. So experience-based trading in this particular example, once again, I'm not talking about, there are so many different experience-based trading happening outside. I'm just talking about this particular system that I'm using myself for years and years now. So I know its winning rate is about 60 to 70%. Not too bad, but not like crazy good either, right? You still have nice runs and nice wins. It's using resistance and support for profit target, or using your resistance support for the stop loss and the entries. It works very well in the bull market, especially for not necessarily the market, bull market, but bull market in terms of for the instrument. It works horribly for the bear market or the correction market, for it has more losses than wins for that instrument. It is the mean reversion type, as I said. It has the profit target, it has the stop loss, and has the specific type of how we enter. You do need to monitor instruments at all times for this to work, and you need to use a lot of discretion on when to use which instrument to use, where to go to. Let's say instead of working with just Algo, I would have probably worked with maybe 5 different stocks at a time, right? Because if I go into 10 to 20 different stocks, it becomes just a mess. Very hard to keep track what's going on, where it's going on, how to move, not to move. It just becomes a little bit messier if you do it that way. But it is possible, probably up to 10 to 20 stocks to work at any given moment. As I said, with specific still rules of the position sizing. I'm just not randomly entering. Make sure that understand that. There is a specific setup. There's why there's specific risk to reward ratio. So I'm entering with specific sizing. So if I enter into 10 stocks, I will be separating it by 10 stocks. So meaning that it's not going to be one, like people say, oh, use the 1% risk. No, in this case, I will use a little bit different how I position myself. Okay. Now, let me use the systematic trading in this exact same scenario, same Algo. So I just showing you the system, which is pretty much the same system that we just had, but now you can use this red line, that's the Okla, as a benchmark, and use the brown line is the equity would have been for this particular case. So like how to turn $100,000 into almost 550,000 by now, okay, in 2 years, okay. So that's a significant gain, and I'm using just one example just to give you kind of like a side-to-side comparison, right? So the previous systematic trading would have probably yielded not a lot of results, but a lot of motion and a lot of discretion involved, and a lot of things here. It's a very, very simple system. You can see that sometimes it can return like 600% for this particular case. It's just because the stock was going up that nicely. And all I'm doing, you can see that it only had 24 trades. Well, not 24. What is it? Yeah, 24 total trades. So get in, get out kind of trades. Let me show you some of these trades. Okay, here it enters right here based on these rules, and comes out right here after it hit the trailing stop. Here you can see that it's actually a losing trade. It entered right here, but came out from here. In this case, it's again losing trade. This one is the winning trade. This one is another really nice winning trade, right? It's like it made 89% in one go over from May to June, like in 2 months, 89%, which is nice. Now, what is the system? Well, it's a very simple system. I'm using the SMA stacking, where for the instrument, the 50-day simple moving average has to be above 200 days simple moving average, and the price of the stock itself has to be above 50-day moving average itself, exponential moving average. And what I'm doing is, once these upper conditions are met, if I'm not in a position yet, I will get in only if the very next day I'm rallying at least 2% and hit from the previous closing price. Right? It's called on-stop order. So it goes up until 2%. If it hits, then I get in. If it doesn't hit, then I don't get in. And once I'm in, all I'm doing, I'm just trailing with 20% trailing stop. That's all it is. That's the simplest system, one of the simplest systems ever. You can see the results once again. Let me just scroll back. It's 600% return for one of these years, right? That's just because the stock was making this huge move. And as it was making huge move, we were trailing behind. You can see that from here to here, we were trailing behind, quite literally, right? But here you can see that it stops out and doesn't get in if the rules were not met. Well, remember, when it's like a 50-day moving average is below 200-day moving average, then that's it. Or the price is below the 50-day moving average, that we're not going to get in. So, again, very simple system. Now, is it easy to use? Well, absolutely true. Is it better than discretionary system? Not necessarily, because there are two different types. This one is called the long-term trend following system. The other one was the mean reversion type. But in this case, probably will be much easier to use this one versus the discretion one, because discretion one, I have to monitor it all the time, and still like wonder, should I use this profit target or that profit target, or use this resistance line or that resistance line, or maybe that support line. It's kind of like become a lot more subjective, so it's much harder to actually use. But what about the systematic trading? Is it really, does they have any kind of a cons? Yes, absolutely. As an example, you probably noticed that it never comes out on the top. Like, see that that's the top over there, or like this would have been the top, right? But it always comes out later. It's due to the nature. Okay, it's due to the nature of the long-term trend following. On our channel, we have a lot of explanations for what the long-term trend following is, but basically it's due to its nature. Because its trail is behind, so it never is going to basically quit at the top because there's no profit target. Now, systematic based trading, just to give you an idea, we can use more stocks now, not just Okla, right? Remember, the con for the Okla trade, the discretion trade, is like I need to find the system where I can get in, into a specific stock. So I need to know which stocks to get into. Well, here with systematic based trading, I can actually use a specific system where it will automatically select which stock to trade with. Also, because I will have a lot more stocks under my consideration in this case, I will have much smoother losses and smoother returns, right? It will spread out my risks across multiple things at the same time. So as an example, I will use the same exact system, but now instead of using just Algo, I will use all stocks from NASDAQ 100. Okay, and because now I have multiple stocks, I need to use some kind of a ranking mechanism, saying, okay, which stocks do I get in? Because most of them can be above 50-day moving average, and the averages are also stacked up. Remember the rules? So I'll use the highest dollar value. So basically the most popular stocks of the day, which were the most popular in the last 3 months, basically, right? This is what I will gonna get in the same exact system. My NASDAQ 100 is my benchmark, and you can see that I actually can outperform. I'm entering into 10 stocks at a time in here at 10 position and 10% per position, meaning that I'm only taking the 1/10 of the slice. And you can see that it can outperform the NASDAQ 100 in this case. Not too much, but still outperforms it. If I run it on a longer period now, from 2007 till now, that's the beauty of the systematic trading again, of mechanical systematic trading to be exact. You can see that I'm outperforming the index a lot of times. And again, just to compare, this is what the S&P 500 looks like, right? So NASDAQ 100 is just much more performing index. But here's to show you the idea. Like in 2025, it was been only 3% down actually for the year, right? So, but in 2024, it would have been 61% up. So, in this particular case, I know that, remember, how even for Algo, that when it's a bear market or a correction market, this type of systems don't really work that well, right? So I can use this extra rule, it's called the market filter, where the price of the SPY, which is the S&P 500 ETF, and the NASDAQ 100 index, both of them, have to be respectively above their own 200-day simple moving average. Using this approach, you can see that flatness, right? Because it doesn't let me to trade when the SPY and NASDAQ 100 index are in the downtrend themselves. So like, why bother? Why bother like here? You can see that over here, when the index is falling, we're kind of repeating what it does, right? So it's a death by 1,000 cuts. So why bother to be in the market when the market is in bad condition? So you can see here how we flattened out, which sometimes cash is good. Sitting in cash, it's great when you need to. And you can see how 2022 again flattened out, how the COVID flattened out, right, instead of spiking down. So it doesn't mean that it's going to be, again, great, but it has a nice return, 18 point something percent returns versus the market. This is the S&P 500 market. You can see how much we are outperforming the market, okay? It still has the long-term trend following type of approach, where it sits for a long time. So the average trade duration is 207 trading days. And still outsized returns every time it wins on average versus every time it loses on average, right? So that's the win-loss ratio is 4.2. So just so you understand, this is not as bad anymore. And you can see again, the returns are much better now. And just to finish things off, how about I use the similar approach, but now I have 17 different systems. This is the 3 workshops together that I created last year in 2025. Some of them from 2024 workshops, and they're still performing. I created them in 2024. At the end of 2024, you can see they're still performing in 2025 too. So this particular combination of 3 different workshops, it can create this type of returns. Much more significant than smoother ride. Can I accomplish this type of smoother ride with my discretion trading? Probably not as much, to be honest. Okay, so I'll give you an idea. Again, not a single year, which was the negative year so far, or for this particular combination of 17 systems. So now, who is the winner? In my case, I would say the systematic trading, automated kind, which is in other words called mechanical systematic trading, is the one which is the winner in my case, because I can create very smooth ride Like on a system by system performance, yes. On discretion, you may actually sometimes outperform the systematic trading, because if I choose one system only, yes, I can always probably outperform it with a discretion. But at the same time, it's very hard for me to outperform 17, 20, 30, 50, 100 systems combined together. It's going to be almost impossible for me to trade on a discretion 100 systems together, especially if each one of them holds 10 positions. It's just impossible task at that point in time, right? So that's the reason why smoother ride with systematic trading, lower drawdowns you can accomplish. I can diversify my portfolio more, meaning that I'll have much smaller positions, so it's not as big of a deal. I can have automated entries and exits, automated decision making, meaning that which stocks to even to work with. And that's the reason why, for me personally, I would say systematic mechanical trading specifically is the winner. Now, if you do have questions, write down back to info@tradingsystems.com, or check out our website, tradingsystems.com, and there is a free course over there. I would really encourage you to do that as well, to see what's exactly it is all about. And in case if you're wondering how it all works, you can buy any of our books on Amazon.com, and they're all available. All there's four books now. Lawrence created 3 books, I created 1. I'm actually in the process of trying to finalize my second book as well. Maybe update my first one to be a little bit more relevant with more things that we discover. But otherwise, I will leave you with this. And if you have any comments, leave it below the video as well, and send us a message. So once again, see you next time. Bye.